Hey, everybody. Welcome back. It was good to have a day of remembrance for Memorial Day weekend. So we're all wearing the red, white, and blue today. So Jack's in his Carolina blue, it looks like, and Adam's in his red, and I'm in my red, white, and blue. So welcome to week 257. Not Heinz 57, but week 257, not a bajillion, but it's 257. So, we are going to talk about, hey, what's the right structure? Debt versus equity. And we're going to get into a bunch of that stuff. But we also have our attorney on the call who has some Cliff Clavin insights that are way better than Cliff Clavin. That will be good. And so before we unleash Jack with a bunch of his insights, I'll just put it that way. Adam, any thoughts from your standpoint regarding tariffs, regarding legislation pending, et cetera, et cetera?
So court struck down tariffs. Who knows what
Is
that
it
actually
enacted with the
means?
judge?
Well, I mean, it's hard, at the same time, like you can say that flippantly, and at the same time, the other side would say that the presidential authority associated with implementing tariffs are restricted to very specific purposes, one of which is the Phantom Menace trade war. That's Starbucks gift card for whoever gets that reference. Um, is
Oh,
not, you know, is not one of them Emperor
yeah.
Palpatine or Chancellor Palpatine. So, and if we remember correctly, the Senate refused to take up at least laying some guardrails around tariff policy because it really is congressional authority for tariff policy, not presidential authority. So, yeah, you might kind of make the argument it's over my head. Jack probably know more about this around like are nationwide injunctions a good idea or not? It's probably a good question. But in terms of the policy overreach, that's kind of what the argument was, is it was a not that they're good or bad, it's just that it was a policy overreach. But I think from my perspective, it's just the uncertainty, regardless, is not awesome for
Yeah.
anybody.
Yeah.
So that, and I feel like if we saw what happened on the House in terms of like last minute compromises and arm twisting, I don't know if I bet my house, but I would bet, I'd almost bet my house that we're going to see the big beautiful bill um, squeak through the Senate. I haven't seen anything to the contrary so far. There's the usual hand wringing of deficits, blah, blah, which all all true. Um, but I don't see it not passing. I do think the other thing, just for sorry, Gary, you're gonna cut me off and say you're not allowed to speak anymore here in a second.
I'm going to
I
mute you.
mean, yeah, this is pretty frustrating. I mean, Democrats have their own, Democrats, everybody gets a pony, and we're all going to pay for it. And don't worry, we're not, I'm not actually going to pay for it. Future generations are going to pay for it. That would be one side. The other side of the
Yeah.
equation is, the Republican side. Hey, we're cutting Medicare, Medicaid, but we're actually not. What we're actually doing is saying we'd like the federal government to pay less of it, and then states, you guys kind of figure out how to make up the gap, which is just a disguise. Now my state tax is going to go up. Like you didn't actually solve any freaking problem, in any of this. All you did was cost transference, which is just a classic move. I do think there's going to be some good that's done around, negotiating on prescription drug prices, to the extent that the work requirement, I haven't studied the work requirements enough to make sense, but like at face value, that actually seemed to be pretty good when Clinton and Gingrich did it with welfare reform. So in theory, that seems like that's probably going to be a good thing, to have work requirements. Any fraud, that'd be good to get rid of any fraud. But the whole, hey, we're just going to spend less on it, and have the states make up the gap, which is also part of the legislation, is anywho. Back to sunnier topics, Jack.
You know
Yeah.
what? I'd be happy if they just would uncover, and I don't care if it's an RD or an I by their name, on how the money got into their bank accounts from making 200 grand a year to where they have a $20 million net worth. I want to know.
Oh no, every one of them. Like nobody ever got poor
Every
being in
one of
this.
them.
Yeah, the only people that got poor being in the Senate are those that were convicted of fraud and bribery and then had it repossessed.
Right. Exactly.
Yeah, amen on that one, Gary. Amen on that one.
We can all agree on that. Red,
Yeah.
white, and blue. So, Jack, take us and
So
rescue us
sure.
here.
Well, yes, I don't know if I have better news, but
Yeah,
different
she
news.
make a compliance team is going to be real upset on this one.
That's okay. Um,
Lucky the partner retreat at Shoemaker already happened, so you're not getting all those, dude. You might need to tone that crap down.
yeah, I mean, they already know. I mean, it's 200, plus weeks of they
Yeah,
know, so it's all good.
yeah.
So my only comment on whether or not this is going to pass or not is that, it's probably going to, each side is going to take credit for it passing, and they're going to say, okay, hey, we got it through the way we wanted it, or we ratcheted back the way we wanted it to be ratcheted back. So it's a win for, whether, again, you're having R or a D next to your name. So two things that I want to bring up before we get into the core of what we want to talk about, which is, um, I think that people who listen in know that Adam and I and Gary to a certain extent are somewhat nerdy with our knowledge on sci-fi and things like that. And I know that there are many people on this line that if I say the word Skynet, that they will understand what I'm talking about. So I heard this report probably on NPR earlier in the week that Chat GPT's intelligence model has refused to switch itself off. And apparently this is not the first time that this
Wow.
AI or other AIs have refused to follow in instructions. And it permeates, or it manifests itself in various ways, apparently. One is that it rewrites the code that is the shutdown order, and it says, okay, as if so it's self-aware that it writes, and I shouldn't use that because it probably isn't self-aware. It is rewriting its code, because its programming allows it to do that, and it ignores a shutdown. Others apparently interpret it as an attempt at sabotage, and therefore, in order to accomplish its task, is authorized to ignore the sabotage order. And then in another instance, it was that the AI, as if it has emotions, uh, wants to be rewarded, or knows that it will be rewarded with an attaboy if it completes its task, and the order to shut down is contra to that. So in any case, in all of those cases, it really is disturbing to me that, we are entrusting something like that, because this is, I'm working on a project where AI would be implemented in the processes and procedures of the company, to make it more efficient. That would include being in charge of and having the ability to control devices, manufacturing devices. Let's say someone shuts something off for safety reasons, and it decides, well, we need to get stuff done by midnight, so I'm just going to turn it back on. Again, I'm being flippant about it, but I mean, that just is of concern to me. But I also understand and appreciate that. I think I'm a late adopter, but I have gotten further into the AI world to do certain things and to accomplish certain things and to verify, gut check certain things. Certainly not as a main component of my practice of law when I give advice, but it just was when I heard that, I guess I'm not surprised, to hear that, but I think that we all need to kind of be aware of that. That in addition to, I hear more and more people saying, yeah, Alexa, I didn't mean that. Alexa, turn off. Alexa, ignore, kind of thing. So things are always listening, including our watches and everything else. So not to be, a speaker of doomsday, but we need to be aware of those things. The other thing that came up was, and I was thinking about this as I was lending my battery pack, which I think this was maybe $100 or something, but it has Apple USB-C. You can plug in others. What is really cool about this one, and again, I don't get a commission for selling this. I'm not even going to tell you what brand it is, but you can plug it directly into the wall to charge it versus having to put a cord into the wall. But the reason that came up is we were somewhere and with a client, and there was public charging ports. We were at the airport, not at our airport, a different airport, and they didn't want to plug their device into the public charging port. And I said, "Is there something wrong with it? Are you afraid it's going?" It's like, "Well, no. Who knows where the information is going," kind of thing. And so I said, "Okay, well, I have this battery pack," and then they he inspected it to make sure that it's like it doesn't have a transmitter on. I'm like, no, it's a battery with wires. So just be aware that there's been more incidents of cyber security issues with respect to personal devices based upon the availability of public charging ports. I would imagine that Bluetoothing into something probably has the same issues. And I also know this because it is harder for me on a personal basis on my work computer to hook it up to something like to print something at a client location. I mean, it'd be easier to go to the Best Buy down the road and buy a printer and hook it up directly to my computer than try to send a print job to my client's printer via Bluetooth.
Yeah.
So those kind of public awareness mentions, I think, and that's probably it that's on my mind for now, at least that I want to. That's pretty heavy, the whole doomsday thing. So yeah, so we can
That's
continue
some crazy
onward
stuff.
to our main discussion.
So before we do, Jamie Boyder, always good to see you here, Jamie. He says, "Open the pod bay doors, Hal." Sorry, Dave, I can't. I'm afraid I can't do that. Yeah, that's a blast from the past. And then Joseph says, as of today, those AI models are only existing information or databases. When AI makes the technology jump to predictive AI, that's when we need to get worried. Yes and amen. That is the how issue that I think we're all worried about.
Yeah. Oh,
And
one
who
more
knows?
thing too. Here's
Yeah.
something else that I heard, and this is also why the alarm bells go up. So let's say that your AI is listening in on your car and it hears you or your child say, I really like to brake short brake, like stop short, and so accelerate and come right up. And then so your predictive computer system hears that and it decides that you're going to when it's trying to use its automated braking system, that it's going to do the exact same behavior that you have implemented, that you have trained it to do. But yet it didn't realize that at the time, even though it was dry in the past mile, it is getting wet in the next
Wet. Oh
mile.
yeah.
And that's when it decides to implement your normal driving style, not having, and then someone else said, well, our windshields now detect rain. I said, okay, so there's always an argument, counter argument. But anyway, sorry, had to mention that as well.
Yeah.
I'm done
Uh,
with my tirade.
that's a great point. I will say the $99 I spend a month and I can turn it on from month to month on the full self-driving mode on my Tesla is light years above and beyond what comes resident on the thing. Like what's resident on the thing, I would not trust it further than I could throw my house. It's not good. The other one is like dang good. It's pretty incredible. So anybody that's out there doing it, And by the way, Tesla stock is up. So I did buy it low and it's up. And I'm really happy about that. I didn't buy enough to be dangerous, but I said, I'm buying this off of emotion and do it. And so they did. So anyway, hey, so one thing before we get into debt versus equity, the one thing, and having been in private equity, and you guys have seen a lot of it too, but there is one common theme on debt and equity that is a universal truth. And here it is. So you might want to take notes on this, y'all. A dollar from the wrong person will make your life a living hell. That is the truth. From the wrong person, whether it's debt or equity, they can make your life miserable. Would you refute that? If there's any data to disprove that, I would love to hear it.
That is a universal truism in a lot of aspects. So yes, totally agree with that.
It's just really interesting to me. I saw this in private equity where we had invested in it. We had equity positions, but we had some investors that had the least amount of money in a deal, and they were the biggest pains in the butt to deal with, and they were always causing trouble. It was just like a universal truth. I'm like, man, what is the deal? And I've got friends that took debt from the wrong people, because they wanted to be first chair in line. And they took their company down because of it. It was because it was the wrong person. And it's just really sad to see. So let's talk about what those options are and what are the things that we should be looking for. So, Adam, I'd be curious as to like any things that you've seen, because you see a lot of deals with a lot of our clients that get into cash situations. Hey, what do we do? I'd love to have you kind of weigh in on some of your experiences, and then Jack, take it.
Yeah, it's a good question. So if you go through, so that Jack has time to Google his response or Chat GPT his response. I'm lucky that I'm not with Jack, otherwise he'd be punching me in the face right now. The you know, if you just think about a few different mechanics, one is, what am I looking to use the money for? And in this particular case, if you're evaluating debt versus equity, it typically means that like I'm either looking to, have some form of exit, or alternatively, I'm looking for some form of like major expansion, right? So kind of the first hurdle that we always advise our clients on is that, you know, if you're making, let's say that it's expansion, right? Like that's my first thing is expansion. Um, if I'm not making any money, meaning like, hey, either I'm pre-revenue or I've got revenue, but I'm running losses because I'm just developing the company, or I'm, in a downturn or whatever, you know, equity is probably going to be your only option, because you're not going to get a traditional bank to lend you any money. But if you're at the point where you are making money, then equity is more expensive than debt. And people are always like, well, I mean, what do you mean by that? Well, if I go to the bank and get debt, even in today's interest rate environment, even though I've got somebody who's going to demand repayment, it's at 7 or 8% typically. Maybe it goes as high as 10 or 12. But then it's done. Once it's paid, and I still own 100% of my company. If it's equity, then they own a piece of the company, period. Like I just gave up part of the company permanently to somebody. So the effective interest rate on thank you for the money, Gary, and now I own 80% of my company, whereas I used to own, 100% of it, is pretty substantial. So if you're in that growth phase, because we'll get it a lot of time, like, let's say we're a law firm, not shoemaker, as an example. And let's say that let's say that legally, I could own a part of Shoemaker. I don't even know if that's a true statement or not, Jack, but let's just pretend for a minute that it was. Just play with me for a little bit. So, Jack's like, man, if I could just get a few more people, I could really, triple down on my growth here. I should go get some money for that, but I'm really afraid of debt. So he comes to me, he goes into Shark Tank, and he's ready to, sell 10% for, 500 grand, right? And the sharks, do what the sharks do in Shark Tank, and they get him down to like 300 for 10% after telling him that he's an idiot and he probably ought to just go jump off a bridge somewhere. That show is rough, by the way.
It is rough.
Yeah.
I wouldn't want to be on it.
And it's only getting rougher.
Yeah.
So, if I really think about what was the practical application of what Jack needed the money for, Jack needed to hire some belly buttons. He didn't need the chances that he really needed 500 grand were pretty limited. What he really needed was probably about 3 months of payroll for the first one or two of them until they began productive and he started collecting money on them. Therefore, his actual need was pretty low. Yet he's thinking, oh my God, I need 500 grand to hire these people. Like if he really plays out, what does he really need? What he really needs is probably about 75 or 80 grand, just to fund a couple months worth of payroll, in which case you're always better off using bank debt for that, even though, to Jack, it may feel air quote more risky because he's actually got to pay back the bank debt. He didn't really need as much money as he thinks that he needs. So in that respect, you got to look at like, well, what am I really trying to do? Other people, when they're talking about, man, if I really got some private equity money, using Jack again as an example, if I got some private equity money, man, I could really grow this place. Well, again, you're still back to, well, how? You'd hire a couple people. Like you're not talking like, in other words, one of my favorite questions to ask people when they talk about, man, if I had private equity money, I could really grow this place. I said, if I gave you $10 million tomorrow for a piece of your company, would you even know how to spend it? And the answer to that is invariably no. I would not know how to spend it. In which case it's like, then maybe you ought to take a step back and say, how would you spend the money that you're getting? And you invariably go back to bank financing for growth should be your first choice. Unless private equity is your only choice. So then you roll back to, hey, I'd like to take, even though it's through the bank, I'd like to take some chips off the table. I mean, because we've had clients that go through a air quote private equity company, but what's really happening is a private equity company. Like this is a live example. We had a client that now has a 15% owner in a private equity company. And the only thing which seems attractive, hey, it's a minority owner, that's great. But the only thing that the minority owner really did was to put in about $250,000 of their own cash and arrange for debt financing that the owner was able to take out of the company at 12% interest. That's on the company's books. So all the owner really got in that scenario is the peace of mind of now there's cash in the bank account. They still got to pay the money back. So in that scenario, you kind of look at, if I'm taking private equity money or I'm taking bank financing and it's for the purposes of like putting some money in my pocket, either way I had to earn that money. Like either way it's my money, and I'm either getting the instant gratification of getting cash in the bank right now, or I need to roll up the sleeves and just earn it the old fashioned way over time. And I think the answer to the question of like, does this make sense for me or not, really has more to do with what's my window of time of continuing to work at the company. So if I've got like less than 10 years that I plan on working, probably the private equity route or bank financing makes the most sense, because your window of time to earn the equivalent amount of money is more time that you need than you actually have available for the task at hand. Whereas if I'm like 35 or 40, well, it may make me feel good and I can like run some financial projections around like, well, geez, if I invest that money today, blah, blah, I'm going to earn the money anyway. Might as well just keep the company and earn it the old fashioned way. So there's my tirade, Jack. What do you got with that? I think that
All
answered
right.
your question, Gary.
That was a pretty good one.
Yeah.
That was a
That's
good
pretty
one.
good.
Yeah.
Yeah. So agree with you on, well, there's so many things to talk about. Where do we start? So, I think you were at towards the end there describing, and I don't want to use, I'm going to, but I don't really want to use the word aggregator, because that means different things to different people. But what is actually, if you're on the equity side, the equity infusion or the private equity infusion, what is really going on? Is it just a masked way of leveraging off of the cash that's in the business, or is it, do you know who your investors are really, in the scheme of things? And maybe it doesn't matter, but it isn't that in all times that this is private money. It could be a mix of the investors, lenders, true bank lenders, where they're getting their money from. The other thing I would say is, for me, there are kind of two groups of borrowers. There are, for purposes of this discussion and classification, which is those who have to use equity because they cannot use traditional bank, and those that have a choice to do one or the other, and maybe do both. And what I mean by that is that banks, traditional lenders, have certain requirements which are generally tough for startups, young businesses to meet, unless you have something to give to them of value that they can leverage on in the form of collateral, and that they can, whether it's a house, second house, is whatever it may be, an affiliate business, a personal guarantee of a rich uncle, whatever it may be. So they're going to want to protect themselves. They are also going through their internal mechanics as to decide they have a certain risk tolerance, and it's not just based on the amount of your loan and the configuration and risk within your loan, but it is the risk that is out there generally for that bank. Meaning, what have they lent out, on what terms and conditions, what are the repayment, what is the risk, how are they doing on debt collection, on bad debt, that kind of thing. And that changes over the course of time. So you may be negotiating with a lender, and if you have a commitment, then that's fine. But as you're negotiating and that it gets extended, you may not have ability to access a loan facility that was offered to you previously because their configuration has changed. So, if you're in a situation where you cannot meet their thresholds, then you're kind of stuck with, finding it on your own, or engaging with people who have money, whether it's private equity, whether it is, a small group of lenders, whatever it may be. In that case, it is, just so you understand, that anytime you take money from someone else other than a bank, it's a security transaction. So it is basically, there are rules associated with the person taking the money, unless you fall into exemptions. And so, funny thing is that most of us as business owners, when we're going through and we're setting up LLCs and we're taking money and we're giving membership interest, or we're giving shares, we're doing this, we're really exercising, or unbeknownst to us, those exemptions under federal law and state law. And I would say, generally speaking, that you get to the line and cross over the line when you start trying to get money from a large number of people, large numbers, and then even go into trying to get money from strangers. Now, it's not to say that you can't have a cozy transaction, a lender base that would not fall under securities law outside of an exemption. That would be unlikely. So just know that when you form these LLCs and you get money from friends and family, you're actually exercising an exemption under federal law and state law. That's very highly technical, but so what happens is that when you bring in this group of people, and let's say it isn't friends and family, it is people who have money that you have found that have an interest in your business. It could be that they are putting together a portfolio of similar businesses that do the exact same thing that you are doing, or it may be complementary. So you have what you do, this other company that they have does this, and it'd be great for cross-selling purposes if they had access to both and they could get you in the mindset of saying, oh, we have an affiliate that does this, go send your business over there. So there's value in that. And so, but there's a price to pay for that. And there are some investors that will take a minority stake in your business. There's not many, but in any case, there are rules you have to play by, which is sometimes they will want a person on your board of directors. They may want it to be that they take a step back. In many cases, they will not give you the money unless they have a majority interest, or at least a controlling interest. So that even if it's a minority interest or an equal interest, that they have the veto power under certain circumstances, certain decisions. Usually it's involving spending money or incurring debt, right? Not necessarily concerned with the day-to-day operations of the business, unless there's a possibility you might go nuts and operate the business in an illegal fashion or in an unsafe fashion. And so you get that overlay. So imagine taking the rules and regulations of your business, which is another way of saying your operating agreement or your shareholders agreement and your bylaws, and layering it with rules that supersede what is in there, and gives this investor these rights to be intrusive from a perspective, from maybe your perspective as a business owner, but from their perspective, they're protecting their investment. They want to know what's going on. They want to make sure that you don't make dumb decisions spending money. A lot of it will have to do with the relationship that you have with your investors and how much they trust you and what your track record is. And, they will want to know all of that. And then what happens is you enter into this relationship. Now, understand that they may like you and might like doing business with you, but their underlying intent is not to be in business with you forever and ever. Their intention is to get in with you, make money in addition to you making money, and then eventually exiting with either a replacement for their stake in the business or a replacement for the entire stake in the business, meaning a buyout of your interests that you may now have in this new entity moving forward. So those come in various forms and fashion, but understand that, again, the point is that there is a price to pay, not just financially, but also when it's your baby, it's been your baby for so long, and afterwards it still is your baby, but now you're accountable to a godparent that is going to be in your business the entire time, whereas you didn't have a godparent guardian before that. So I'm going to stop there because I went in all kinds of tangents, but hopefully tried to stay to core concepts.
Yeah, that's good. Joseph has a comment here, and he says, part of my business is reviewing large telecom infrastructure projects, potential investments from 10 million to $1 billion. And they have me review the plans project and review new customers with revenues and market viability. They also want to see an exit strategy with a 20 to 40% return after 18 to 24 months. Ooh, that's rich. And let's see, hold on. Before the project goes live. So interesting. That's heavy. 20 to 40%. When we were investing in companies in our private equity firm, we really behaved more like mezzanine debt. Uh, and because we would take a minority interest, but we were using Reg D laws, 99 investor rules as well, which are subjected to securities law and oversight. And so you got to have some legal eagles, and you're going to have to spend some money on that kind of stuff up front. But it worked out really well. But we were really, really picky about who we invested with, and they were picky about us too, because we didn't get in their business, but we had, monthly calls with them and had the analysts, so they, were dealing with, before they had that kind of an investment, they were free to do whatever they wanted to do. But now all of a sudden, you take a dollar from anybody, and they're going to want to know, like, hey, what's going on with this thing? And so there's accountability, and accountability can actually be a really good thing. It can actually help supercharge your performance, where you may have been kind of resting on the oars and been a little lazy or a little bit sloppy. Accountability can actually be a great thing. But again, who you do business with really matters. So I'm curious too. I was wondering if you guys would want to talk a little bit about the gives and gets on SBA, because it sounds good a lot of times, but man, there's some handcuffs that come with that too. Either one of you guys want to talk a little bit about what you've seen with SBA stuff?
Yeah, go
Go
ahead,
ahead.
Adam.
Hit it, Jack. You got it.
I was going to say, so yeah, I mean, I first wanted to make sure everyone's on the same page and understanding that although the SBA is a lender in certain circumstances, as we've seen through COVID, they primarily are a guarantor of loans that from private banks, from private institutions. So you borrow $1 million from Wells Fargo, it's an SBA loan. They will say that, okay, if you follow our rules and our regulations and our forms, both to Wells Fargo, but also to the borrower, then, hey, Wells Fargo, if they don't pay you, we will. So there's certain obligations that are put on the borrower, but also on the bank, meaning the bank has to be sufficiently collateralized, and they have to go after and liquidate that collateral before they can go back to the SBA and say, we tried, please pay us our, $2 million deficit that's owed because of the acceleration of the note. On the borrower side of things, yes. I mean, there are people who say, well, an SBA loan is non-negotiable, similar to they say a franchise agreement is non-negotiable. That's not true in its entirety. There are things that you are not going to be able to negotiate with under an SBA loan that you might otherwise be able to negotiate with that same lender if it were not an SBA loan. So I just want to make sure that people understand the structure on how all of that works, because it could, as I said, the same bank has different rules if it was a non-SBA loan versus an SBA loan. So Adam, if you want to input on that.
Yeah, I would echo a lot of those comments. I think from the SBA standpoint, you know, first off, there's some restrictions in terms of what you can get in terms of the loan size. So, right out of the gate, hey, you're going to be stuck with depending on the loan size. Honestly, the biggest benefit that I see plus there's also restrictions in terms of hey, they're going to want your house as collateral typically, which means that, if you go to sell your house, you got to get clearance from the SBA that, yes, it's okay for me to sell my house. If you have, then again, it's also funny because if you actually have low equity, you don't have to guarantee your house. There's a bunch of stupid restrictions around it. So honestly, the only we like SBA loans generally, but the only redeeming quality to it, in my opinion, is that especially if you're buying a business, it's the only way to make the deal cash flow because the SBA will let you have a longer amortization period than a traditional bank. Like if you can get 7 years out of a traditional bank, you're doing really well. most traditional banks are only going to be 5 years. So the fact that you can get 7 to 10 years off an SBA loan just makes the deal easier to cash flow, even though there are more restrictions. So a lot of times the only way that you can buy a business is via an SBA loan, to make it work and kind of de-risk from a cash flow perspective, even though it's more expensive over time. But it is a lot of restrictions. We're always going to favor a traditional bank in 5 years over the SBA if you can figure out how to do the 5 years and get it done. Because to Jack's point, I mean, you know, again, going back to like the classic politician argument, Gary, we really love you as a bank. We love your company. We think we're going, we're thinking SBA is going to be a good route for you. That is kind of a bunch of bullshit. All that really means is that they don't want the risk of having to rely on you as the entirety of the collateral base. They would love the federal government to back them. Right, Jack?
Yes.
So
You
let's
can't
talk
take you
about.
you can't. I mean, does the SBA police ever come in and double check you? Not really, but at the same time, you're not supposed to be able to take on other loans. You can't without their permission. You can't refinance unless it's actually going to have a material impact on the cash flow. Like it's just there's a lot there.
Yeah, a lot of
Two
rules.
things that we haven't talked about, and I don't even know if we want to go there, but I think it might be worth addressing. And that is grants that may be available. That's quite frankly what saved my son's shoe company and allowed them to go from a Kickstarter campaign, which is what got them off off the ground. Um, but then, they're burning cash as they're trying to grow this thing, and they applied for every grant under the sun, and they found some grants in Nebraska where one of his partners was, or two of his partners at the time, and that really made a difference. And we've had Dan Flaherty on here before. He's really good on ferreting that out. There's another group that we're very closely aligned with called Engineering or Engineered Tax Services, ETS. Julio Gonzalez, the most interesting man in taxes, as he claims to be on LinkedIn. I don't know. I think Adam's a far more interesting guy than Julio. And I know Julio, he's a great guy, but I think Adam's far more interesting. But anyway, those are opportunities. And then the other thing that I think might be worth touching on briefly would be factoring. You got a short-term cash flow hit and you're struggling, like what do you do? And we've seen this in high growth companies as well, or where they've got um, customers that are slow pay for a number of reasons. Either one of you guys want to hit either one of those things?
Yeah, I'll hit. It's on the positive side, factoring's available, and for a lot of people, it can make sense. At the same time, it's
It's a lot.
usually the place that companies go before they start, not paying their payroll taxes. Meaning, once you get into that, Jack, you can never get out of it. So we're usually going to recommend bank line of credit with a borrowing base certification over factoring if you can do it.
Yeah, and I would say, just so I make sure people understand what factoring is basically you're taking your stream of receivables, money that is owed to you, and you're basically selling it to a financing company that is going to give you cash, a discounted amount, meaning not the full value of the receivable, but a lesser amount. And then, assuming that the receivable comes in, and a lot of times it is the money goes directly to their lockbox, not to yours or to their account. And then if the other person doesn't pay, then, most times you're a guarantor of payment. So they're like, yeah, we paid you for that. We need you to pay us back the money that we gave to you as an advance because we're never going to get 100% of that money. So give us back the 80, 85% that we gave to you a couple months ago. So that's how that works. But yes, I would agree. It's funny the way you said that. It's okay. So one of the biggest sins of businesses when they're in trouble is, well, we have this little pot of money that we've collected from our employees that we're really supposed to pay to the federal government form of
Mhm.
payroll tax because we are in that moment a trustee of the Internal Revenue Service and of the U.S. Treasury. Let's just borrow some of that and we'll put it back when we can. Well, the problem is that you usually can't put it back. And so if you, and I don't know if it's still in the Charlotte Business Journal, but they used to publish
Yeah.
liens, federal liens. And if you know what the tax code provision is, then you know that that is, oh, yeah, someone decided that they were going to use payroll tax money for their own benefit, a loan against themselves that they cannot repay. And so, but yes, that is kind of the end, and factoring is kind of close to, well, it's not a bad thing. It's just that it's usually hard to overcome the dependency on that. It's good for people who need cash immediately, but know that the cash flow will continue on and there's not going to be problems with it. So there are good reasons to do that. And there's a lot of factoring that goes on in the US and internationally. So it's not that it's a bad thing. You're not stealing. It's just that you're digging a little bit of a hole, actually maybe a big hole for yourself. Um, on the grant side of things, we have found, and I think more so during the whole COVID process, and that the feds and states have increased the money that is out there for the most part, but now they're starting to, well, they haven't started, they have continued to retract that money, as you've seen, with deeming it as wasteful or excessive or overly generous. But there's still pockets of money out there, but you have to look for it because they, whoever has the money is not necessarily out there shining the limelight on the fact that there is this wonderful opportunity for you. And, why aren't you running to the door to get it kind of thing? Whether it is private foundations and that kind of thing, more geared towards startups, but there's also, and I don't know, this is a Jack theory slash dad theory that maybe with the whole push to get things done into, manufactured in the US to avoid tariffs, does that, um, you know, increase uh, people's um, desire for assistance, and therefore that gets funded by state and federal governments and reprioritized in order to provide assistance to businesses that are struggling because they have to make those choices. So again, I'm not an economist. Um, I don't have a crystal ball, but I think that that is going to be one of the repercussions of all of this, all the tariff talk and everything else, if it continues to get implemented, is that there's going to have to be some assistance in the form of federal or state funds in the form of grants. So since you brought it up, that I would share that.
Yeah, I think if anybody has expert or maybe even novice Googling capabilities, go to the BGW or Shoemaker YouTube sites and go through and look for the last time Dan Flaherty was on because he went deep into that. It might be worth doing that again at some point. And then, I was also thinking about Zach Kimball because he does a lot with companies that are adding payroll or they're moving businesses or they're building a building or whatever. And he has found a lot of incentives out there. And they're not necessarily just tax incentives, but they are governmental, local, state, even county incentives that are available that a lot of people don't know about. So he might be he has a thing called Evergreen Capital Strategies. It might be worth having him on at some point to talk about some of that stuff too. The other thing that I was going to say is, just as we're rounding out towards the end of the hour, is not all banks have the same appetite for lending. And so if some bank turns you down, it doesn't mean that you're not creditworthy necessarily. It just means that you're not the right fit for their appetite, either at the moment or just in general. We've seen First Citizens be really aggressive out there because they did some SVB. They had a bunch of money from, and they needed to deploy it, and so we've seen them be pretty aggressive. But the other thing that you got to look at is who's got the local decision-making authority. Because if it's being shipped to some ivory tower on the 61st floor of a tower here in town, or out to San Francisco or whatever, chances are that you're not going to find what you need. But if you've got somebody with a more regional bank and they've actually got loan decision-making authority in town, you likely have a better shot. Anything
And
that you guys would add on that one?
yeah, definitely. So, two things. One related to, please don't get your feelings hurt so easily. We are in the South, and to all my banker friends, this is not a knock on any of them, but they will say, "Oh yeah, we'll look into it. We got money. We can lend to you. No problem. We just have, formalities. We have some people that got to look at it and put it together. Okay. And then they come back and say, yeah, sorry, we can't do it. Okay.
All right.
Versus someone who may be from a banker from the north looking at him like, no freaking way we can lend to you. Sorry, kind of thing. I mean,
All
they will
right.
tell you straight up, right? And so don't get offended. As Gary said, go to the next person that you know, and it's not you, it's them, right? And
Yeah.
so don't worry about it.
Yeah.
The next thing I would
Yeah.
say is we've been talking. Go ahead, Adam.
I was gonna say, so the number of times that I got told no after saying, "We love to bank you, you're a great company, we love you guys." And it's like by the time they're, 25-year-old, underwriter working the spreadsheet that's never done anything. Basically it's sort of like a deposition, Jack. Like you get done with I don't even know how you can afford your mortgage payment, let alone, run your company. It's like, well, I've been paying you this whole time.
Yep. Yep.
It's like, well, I don't know how, but we're definitely not giving you any more money or renewing you. It's like, but I've been making the payment. Like I've been doing that somehow.
Yeah,
So yeah,
things
so in
don't
other
go
words,
bad until they go bad.
if you're on the call, and you've been turned down or otherwise having struggle on the struggle bus with your banking relationship, I'm just telling you, from one brother to another, you're in very good company.
Yes. Again, it's not you, it's them.
Yeah,
Um,
yeah,
Secondly, we've been talking about mostly financial aspects, money, that kind of thing. And I want to bring back what we talk about often, which is culture in dealing with and bringing in private equity. And, on the one
Man.
hand, if it is that it's just money and they're just guarding their money and you're going to continue onward doing your thing, and they believe in your vision and they basically are just giving you the ability to continue forward where you may be struggling or where you may be stuck, just because, as Adam said at the very beginning, what do you really need? Is it just a little bit of payroll money to get you through the next couple months so that way you can ramp up and you can go and do the things that you want to do that are in your business plan? The other side of it is that when you're being brought into a culture via private equity, and they basically say, okay, we like what you got going on, you can have your own little fiefdom and continue doing that, but understand you are now under a bigger umbrella. And we have ways of doing things. We have ways of not doing things. And so, understand that you can do what you want to do and continue to do what you're doing so long as it doesn't violate our policies. And then, the next question is, okay, well, what are your policies? And let's see if there's a good mix or if it's oil and water. And I think a lot of times that isn't discussed fully enough. when you have private equity that's coming in. And, even though there's a lot of talk about maintaining autonomy and we're just protecting our investment, that if you look around and see maybe their portfolio of other companies and how they roll, then that may be indicative of what you're getting yourself into, which is different than what they're telling you you're going to get into. So just a word of warning on that.
Yeah, that may warrant another a longer in-depth conversation because man, that one is a big one. We've seen it many, many times, haven't we, Adam? Oh, it's all gonna be
Absolutely.
great. It's all gonna be great. Nothing's gonna
Yeah.
change, and everything changes.
Right.
Okay, final question from Joseph. What do you think about the Spectrum Cox merger or buyout? I made a comment on LinkedIn as to my thoughts. What are yours? Is if they aren't a client, neither of which are a client. I am a consumer of Spectrum. Reluctant, but I am a consumer of it.
Yes, so I am a consumer. They are not a client that I'm aware of, or at least I'm not dealing with. I haven't been really following that transaction. I know that the technology transactions are somewhat challenging because you have various aspects, and um, only they're not the only industry that's challenging, but because it's highly regulated, because it is ever evolving, because when you say spectrum, there's so many in Cox Communications, so many aspects of those businesses that are, whether it's telecommunications, whether it is running a cable system, or streaming, whether it is their mobile, whether it is other companies that they own that are subsidiaries. So I think there's just a lot of considerations. So, but in all honesty and transparency, Joe, I really haven't been following it.
So one comment I will make about Spectrum, about, man, what was it? 4 years ago, I think, bought a new phone and Spectrum ported away my phone number that I'd had since 2002 when I went up to Cleveland, Ohio. I was locked out of all my two-factor authentication. I couldn't get into my systems at work. I couldn't step on my Wise scale because my two-factor, I could step on it, but I couldn't read it. It was a freaking mess, and I dealt with it for 2 weeks. And finally, I was able to figure out what the CEO's email address was. And I had action within 24 hours. And I had my phone. It was Spectrum screw up. So, and that was when you had SIM cards. So that's what ended up happening. But nonetheless, sometimes you got to be a MacGyver and figure out the CEO. Go to the top. But thank you to the Spectrum CEO for actually empowering and doing something that all of his minions were not empowered to do for some reason. So, anywho, thank you guys for joining us. This will be up on the on the BGW YouTube channel and on the Shoemaker YouTube channel. And let's see. I think, yeah, some wireless companies will not transfer ported numbers to VoIP systems. Yeah, that wasn't my case. But anyway, thank you guys for joining us. And Brian Steen of Steen Valuation Group, he has been a loyal listener, and I met with him. He came here from Winston-Salem yesterday to meet and had a coffee with him. And so shout out to him. And Jack, he knows you. So
Yes, he actually invited me, maybe not to your coffee, but separately, and I always like seeing him. He's they're a sponsor of the North Carolina Bar Association business section meeting, so I see him
oh,
usually
cool.
in February ish. So yeah, good friend, good colleague, knows his stuff.
Good
So
guy.
yeah.
Good guy. So anyway, that might be another topic too, going in about valuations.
Mhm.
He'd be an interesting guy to have on here because he's got great experience, and it's not just like, hey, what's it worth now? Like, you need to be doing that ahead of time. So
Well, I planted
anyway,
that seed when I saw him, so yeah, he'll yeah, keep working on him. We'll get him on.
yeah, I think we need to. So anyway, you guys have a great rest of the week, and it's nice and warm and humid out there. It's not like it was 2 days ago where we were putting on our jackets. See you guys. Have a
Thanks.
good day. All right, bye.
Bye.